Well, the Goldilocks environment of 2017 synchronized sustainable growth, subdued inflation, meaning central banks could maintain loose policy, very good environment for the corporate sector, strong corporate performance. That continued into the first few weeks of 2018. But then towards the end of January, there was quite a sudden, sharp sell-off in markets, a big spike in volatility, and the first serious move we've had such as that in 15 months or so. And in fact, by the end of the quarter, most markets, nearly all developed markets, were actually down on the quarter. So MSCI World Index down 1% or so. Emerging markets managed to eke out a small gain, 1%. But generally speaking, most markets lost about 10% from the peaks at the end of January to the end of the quarter. Well, the immediate trigger was mounting evidence of accelerating wage inflation in the US. Pretty important metric that investors have been following because unemployment levels are at multi-decade lows in the US. That in turn meant there was a growing conviction amongst investors that the Fed would certainly reach its target of monetary tightening during the course of this year, may even have to accelerate that process. At the same time, bonds had been selling off for a few months. Back in September last year, the 10-year bond yield in the US was 2%. By the time it got into the end of February, it was 2.9%. So that was undermining the sort of valuation basis of equities in particular. So we had that sort of combination of factors which made people think that there was a risk now of an acceleration of monetary tightening in the course of this year. And on top of that, we've had Trump's tax cuts, his plans for infrastructure spending, all of which would come on top of an economy in the US which is expanding at close to its long-term potential, again creating that concern that inflation would begin to accelerate and hence monetary policy would have to tighten further. Then we had a number of other factors that came along. Since Trump got elected, we've all been a bit concerned about the risks of protectionism, trade wars. Well, that came to the fore when Trump introduced proposals for tariffs on steel and aluminium, and then quite significant tariffs on a whole range of goods imported from China. China retaliated immediately, so the fears of a trade war really accelerated quite a lot. Then sort of out of the blue a little bit came concerns about the big tech stocks. There was a very big sell-off in those market leaders, what were called the FANGs in 2017, triggered really by a big data breach by Facebook. But what it gave rise to was concerns that governments were going to clamp down very heavily in terms of regulations in what has been a very loosely regulated group of companies historically. And not only that, there is quite clear evidence that governments are looking to impose much more significant taxes on these companies than to date. They've been getting away with very low taxes by booking revenues in low tax jurisdictions. And then finally, as the quarter wore on, we began to see evidence that the very strong growth momentum in the global economy as we entered this year was just beginning to lose some of that momentum. Well, no, there were no great signs of stress in markets. There was certainly not a liquidity event. Gold was up a couple of percent over the quarter, but it stayed within its established trading range of the past 5 years, didn't break out of that. The yen, which has become a safe haven currency over the past few years, did appreciate by close to 6%, but that came at a time when the dollar was weak against pretty much all currencies, so sterling was up nearly 4%, euro 2.5%. Treasuries did rally a bit in March, but still ended down on the quarter. So no great signs of rush into safe haven assets there. Asset classes which typically don't do very well or sell off in periods of market weakness. Emerging market equities, for instance, well, they perform broadly in line with developed equities, down 10% or thereabouts from the peak to the end quarter lows. Credit performed a little bit worse than treasuries, but not very much, so broadly in line. In fact, this is at the moment what's happening in bond markets is really all about rising inflation and rising interest rates. There's no rise in credit risk. In fact, perhaps the most notable change in bond markets in the course of recent months, perhaps over the past 12 months or so, is quite a sharp flattening of the yield curve. If you look at the yield on 2-year treasuries today, it's much closer to the yield on 10-year bonds that it's been. In fact, it's at the lowest level now since before the financial crisis, about 50 basis points. Quite often that sort of flattening of the yield curve is a precursor to more difficult economic conditions, but I think that's not being flagged by this change. That's more about the fact that bond yields remain very low. The interesting thing is that at 2.3%, the yield on 2-year treasuries is now the highest it's been since before the financial crisis, and for the first time in a very long time, cash or near cash instruments are offering yields which are close to or possibly even above the long-term rate of inflation in the US. So you're now getting a little bit of real yield from these instruments for the first time in a long time. Cash is becoming again, for the first time in a long time, a bit more of a serious defensive asset. Well, for once there have been a couple of positive developments. First of all, the UK and EU agreed on a 21-month transition period once the UK leaves the EU in a year's time. And that's an important breakthrough because it gives a much longer period of time for the negotiations over the UK's future relationship with the EU, and it gives businesses more time to prepare for Brexit. Incidentally, it also certainly means, in my view, the end of any prospect of Brexit being overturned. There's been some talk amongst the remainers of a second referendum. It's always a pretty remote possibility, but that's now, I think, completely impossible. I think it begins to sort of create an opportunity in UK equities. There's still a lot of economic uncertainty overhanging sort of Brexit, but it's beginning to look clear that some sort of a deal will emerge out of this thing. UK equities have underperformed the rest of the world by quite a margin over the course of the past 12 or 18 months, and it's creating quite some interesting valuation opportunities. So that's, I think, an interesting area. Arguably of much more importance on the global stage was a thawing of relationships in the Korean Peninsula. And of course the world is now waiting for Trump's meeting with Kim Jong-un. If those meetings go successfully, then it's got the possibility of removing a big tail risk for markets, with the risk of an all-out conflict in the Korean Peninsula diminishing very substantially. So I think a couple of quite reasonable positive developments in the quarter. Well, I don't think it'll be geopolitics. I think it'll be central bank policy action that will drive markets through the remainder of this year. Yes, there is a risk that Trump's protectionist policies could lead to an all-out trade war, but as things stand with the proposals that he's got on the table at the moment, even if they're implemented in full, which is pretty unlikely, there are clearly going to be negotiations between the US and China now. Even if they are implemented in full, the impact on the global economy is really very minor. Inflation is something we're watching out for, and acceleration inflation would be a concern, because that would mean the Fed would have to tighten policy more aggressively. But on the current path of growth and inflation, I think the Fed will do what it's planned to do this year: 2 more rate rises after the 0.25% rate rise in March, and continue with its balance sheet reduction program. It was notable that in the March meeting of the Fed, they raised their projections for interest rates in 2019 and 20 by 0.5% in aggregate. So that's something to watch out for if the economy accelerates away. And of course, at the same time, the ECB is going to be in the process of reducing its asset purchases, tightening policy over the next 12 months. The Bank of England will probably do a little bit. And all of that, I think, means that there's going to be pressure on bond markets still. It's not a great environment for bonds, this rising interest rates. In aggregate, though, we're looking at a situation where the global economy, yes, it's slowed down a little bit, but it remains pretty good. We've got good growth prospects this year, and I think quite sustainable. Inflation doesn't look as if it's going to roar away. There's plenty of pressures downwards on inflation. So it's still a pretty benign environment for the corporate sector, equity markets in general. And remember, even though monetary policy is tightening, it's still loose by any historical standards. So we see this correction in markets as really quite a healthy thing after a long unbroken run over the previous 15 months or so. We think the cycle has got further to go. We do think it's sustainable. Our preferred asset class is still equities. I think they'll continue to do quite well. More volatility this year because of the heightened uncertainty and this tightening of policy. And certainly in bond markets, we'd want to keep our duration pretty short. But we do think this cycle has got further to run, so we would still encourage investors to stay invested.